So remember, your bills and your utilities, that B and U category, when you add that up, make sure it doesn't exceed 60% of your take-home pay. The next 20% of your pay should go toward your savings. That's your emergency account and that's your goal savings account. So the other 20% should go toward your emergency account, your goal savings account. Now, let me just say this. This is the caveat. Until you have a minimum of $1,200 in your emergency savings account, do not fund your saving goals account. I'm going to repeat that. Until you have at least $1,200 in your emergency savings account, do not start funding your goals savings account. Why? Because we know that emergencies will always happen. Unexpected repairs, anything could happen. Medical emergency, you want to make sure you have at minimum $1,200 in your emergency savings account, and then you can start funding your goals account with 10% while still putting 10% into your emergency account. Because how many months did we say we want you to have for your emergency account? 3 months. So you should have 3 months of your mortgage or rent, 3 months of your utilities, your groceries, your car payment, and car insurance. Next, we talked about the 20%, the last 20% rather, should be used for your personal spending. If you work, you should be able to enjoy some guilt-free spending. So 20% is for you to use autonomously as your guilt-free spending account. Next slide for me, please. Now, last week, very important. Here's where the system comes in. We talked about our buckets. I can't express how important this is. We talked about creating 2 checking accounts. I hope everyone created their checking accounts. So the 2 checking accounts, account number 1 is where all of your money, that's all of your direct deposits, that's all of your side hustle money, that's all of your take-home pay. All of that was to go into your first checking account. So that first checking account receives all of your money. That second checking account is the account that receives all of the money for your bills, for your B category and your U category. So remember, that first checking account, that's the account that has the debit card. That second checking account does not have a debit card. Why? Because you do not want to swipe that second account and take money from your bills and your utilities. So the only account that has a debit card is that first checking account. Because once everything comes out of that first account, what's left over is your guilt-free spending, so you can use your debit card for that account. But remember what I shared with you in the beginning. If you have credit cards that provide perks, rewards, cash back, then you want to use your credit card instead of your debit card. So you want to use your credit card to take care of all of your personal spending, as well as all of your bills and utilities. So some creditors, such as your car payment, your mortgage, they may not take a credit card. Well, that's fine. That'll come out of that second checking account. If your creditor accepts credit cards, you want to use your credit card that provides the perks. Why? Because you receive a benefit from it. You don't receive any benefit from your debit card. But remember the strategy. Once you pay the creditors off with that credit card, you take the money from your account, that second checking account for bills and utilities, and you pay that credit card off and zero that account out. That's very important to remember. We talked about your emergency savings account, and I shared with you the best accounts to use for savings are online accounts, because they do not have the overhead of brick and mortar banks, and they provide you with a higher interest rate, and they do not charge fees. So you don't have to worry about a minimum balance. You don't have to worry about overdraft. None of those fees. So I sent you the links to review all of the online banks, the top online banks for savings accounts for 2022. Your homework was to research which financial depository or bank you wanted to use for your two savings accounts. So that first savings account is for your emergency savings. So that 20% allocation will all go to your emergency savings until you have $1,200. After that, you'll take 10% to keep funding that emergency account. The other 10% will be used for your goal savings account. That's the second savings account. So those are the four buckets that we will have working for us every month in sync. Next slide for me, please. So I just shared this. I'm not gonna be redundant. I'm not gonna go over this again. Next slide for me, please. And I just covered this. As you can see, I'm getting ahead of myself, but it's because I know this information because this is what I practice. I'm not giving you anything that I don't practice. The reason why I'm in a position now and I just paid off one of my last creditors is because I follow this system. So these are the two savings accounts. So please, family, I pray that you are opening these savings accounts online and that you are funding them and that these things are happening automatically. You want this to be automated. Next slide, please. So I just shared, automate all of your monthly fixed expenses to be paid from checking account number 2. Yes. And here's the caveat. Make sure the auto pay dates correspond with your pay periods. So when you reach out to these creditors and you make your utilities and your bills, you want to put those on auto pay, but you want to make sure that the money is coming out in concert with your pay periods so that once they deduct the funds from your account, the money is there. So some bills you're paid the 1st or the 15th because you receive a check that first half of the month. And some bills you're paid at the latter end of the month because that's your second pay cycle, unless you're paid every week. So you want to make sure you automate it and you want to make sure those pay periods run concurrently with your payroll cycles. Next slide for me, please. So now that we've covered that, I want to make sure, I don't want to go too fast. So are there any questions? Do I have any questions in the chat that I need to address before I move on?
No.
Okay. How many people, by raising of hands, have actually opened up their two online savings accounts? Okay, family, that's something I want you to work on this week is opening up those two accounts. That's very important. Centavia, congratulations. So now we're going to talk about the debt elimination plan. So that debt elimination plan, now that you have your four buckets operating for you, it's time now to start focusing on eliminating debt. So the first thing when it comes to eliminating debt, and I want to make this as basic as possible so that everyone can understand, is to assess your debt. Now, in the beginning, we assessed your monthly expenses, but now we want to assess the debt that you owe. So that could be credit card debt, student loan debt, car payments, any debt that you currently owe. So step B is to choose a debt elimination strategy. And there are two strategies that most financial experts espouse to. So you have the snowball method. The snowball method is the method that most agree with. And they agree with that because it builds momentum and it creates small victories. And those small victories create a psychological state where a person now feels that if I can eliminate this debt, I can eliminate another debt. And it puts you into that mind state that you're able then to work your way out of the debt that you're currently in. That's why they love the snowball method so much. So the snowball method, it prioritizes paying off debts from the smallest to the largest. That's the snowball method. Paying your debts, starting with the smallest debt and working your way to the largest debt. Then you have the avalanche method. The avalanche method is where you identify the debt with the highest interest rate and you start eliminating debts based on the interest rate. Now, the reason why financial experts don't espouse as much to the avalanche method is because it can be time consuming to try to pay off that particular debt. And if people are not able to see any momentum early on, then they give up. That's why the snowball method is the method of choice, because you get victories immediately or in short periods of time, should I say. So step C is, once you pick your strategy, we want to automate it. We don't want you worrying about it. You will automate it, and then it will happen every month, and you'll receive a notification once that debt is paid off, and then you can celebrate. One debt down, however many more to go. But the fact that you paid off one, that's a victory, and that's where we want to get you to. Paying off at least one debt so you know that it's possible, and that will put you in the state of mind that I can actually do this. I can pay off these debts, and I can work my way toward financial freedom. Next slide for me, please. So now let's look at debt. Debt is classified into two categories. So you have secured debt and you have unsecured debt. Now, with secured debt, there's an asset. So that's like your house, that's your car. There's collateral, there's an asset backing it. That's secured debt. Unsecured debt, there's no collateral. The only thing it's based on is your credit score, your credit history. So those are the two types of debt. You have secured debt and you have unsecured debt. Next slide for me, please. So now, this is why it's so important. That's why we had you early on to look at your monthly expenses by looking at 3 months of credit card statements, 3 months of bank statements. Now I want you to look at your debt outside of your monthly expenses. And think about this. Fewer than 25% of people know how much debt they owe. So if I was to ask you right now, when it comes to your house, your car, your student loans, give me the round number. How much debt do you owe in total? Do you know what that number is? I want you this week as homework to calculate that number. 95% of people don't know their payoff debts for their debt. Do you know the exact date when you'll pay that car off? When you will pay that house off? You can't plan to pay off your debt until you know exactly how much you owe. That's what I shared with you earlier on. You can't plan to pay off your debt until you know how much debt you owe. That's why I want you to do this for homework. We're not going to be afraid of the debt. We're more than conquerors. We are going to look at the number, we're going to face it, and we're going to eliminate it. Next slide, please. So now let's talk about these debts, credit card debts. So now when you talk about credit card debt, credit cards are a common example of unsecured loans. I just shared that with you. Credit card debt is unsecured, is only backed by what? Your credit score. So based on your credit score, they will issue you a credit card with a limit. So credit card debt is probably the most expensive debt. Now look at this, family. Credit cards, you're paying between 6 and 29%. Do you know what the interest rates are on your credit cards? That's why I share with you, although I don't want you to use your debit card, I want you to link your bills to your credit cards, and I want you to use your credit cards for your personal spending. I'm sharing with you, only charge what you have in the bank. If you don't have the money in the bank, do not pull that card out because you're creating more debt. You want to use your credit card to pay for things that you're able to pay for if you were to use your debit card and then zero account out. That's going to provide you with perks and benefits. So now paying off credit card debt is the best financial decision you will ever make. Several financial experts have said that. So that's why I included it in here. They were saying that credit card debt is the debt that you want to pay off first. Why? Because the interest rates are so high. Next slide, please. So let's look at some vocabulary. Interest rate. That's the cost that you pay each year to borrow money and to use the credit of the guarantor or the grantor, the agency that gave you the credit card. That's the cost that you pay to use their credit or to use their money. The average interest rate on a credit card is around 15%. But watch this. If it's a store card, your Macy's, your Neiman Marcus, your Nordstrom's, whatever card you have, Belk, that credit card percentage is generally around 20 or 25%. So now, what's the difference between the interest rate, and you saw these three letters, the APR, the annual percentage rate. The annual percentage rate includes the interest rate plus any fees that the lender might charge. And that also includes what? The annual fee that some credit cards come with. So the APR is always going to be higher than the interest rate. The average credit card APR is about 17%, and that's according to the Federal Reserve. Next slide, please. So let's look at this example. Judy has $5,000 in debt on a credit card. I want you to look at this. Her APR for that credit card is 14%. If Judy pays the 2% monthly minimum payment, it will take her more than 25 years to pay off that $5,000 debt. Over the entire process, Judy will pay over $6,000 in interest alone. Now, the original debt is only $5,000, but she's going to pay $6,000 in interest. So that's over $11,000 total for a $5,000 debt. That's why you want to eliminate credit card debt first. So here is a strategy. And I was researching this. An extra $100 a month on a credit card can save you years of payments or thousands of dollars. An extra $100 a month. That's why in the beginning I asked you, when you look at your monthly expenses, to negotiate fees, see where you could reduce certain line items. And I asked you, how much did you have left over? So directing an additional $100 a month can save you years of payments on your credit card. Next slide for me, please. Now let's talk about student loan debt, because that's another high form of debt. Student loans and credit card debts are the two largest carried by most Americans. Now watch this. The U.S. has reached $1.5 trillion, not billion, trillion dollars in student loan debt. The average American carries around $33,000 in student loan debt. So by changing your student loan from a 20-year plan to a 10-year plan will save you over $10,000 just by paying an additional $50 a month on your student loan. When you look at the debt calculator, you're able to plug in the numbers and see that putting an additional $50 a month can save you thousands of dollars off your student loan debt. Just $50. So I want you to think about that, family. Next slide for me, please. So debt elimination. We shared with you the snowball model and the avalanche model. Listen to what a study by Northwestern said about the snowball model. A study published by the Northwestern University's Kellogg School of Management found that more bills people were able to eliminate, the more likely they were to work their way out of debt. So the more people saw that they were able to eliminate their small debts, it gave them the mind state or the mentality that they were able to work their way out of eliminating all of their debts. So that's what we want to do, family. We want to start with that snowball effect, and we want to use that to build momentum and to empower us to see that we can eliminate all of our debt. Next slide for me, please. And I just shared this. I'm sorry. Next slide, please. So here's the strategy. This is homework. I want you to list your debts from the smallest to the largest. So if you have credit cards, And I'm going to send you, we created a spreadsheet. That spreadsheet allows you to list all of your credit cards and the interest, the annual percentage rate, the minimum amount you pay, and when you'll pay it off. I want you to list each of those debts from smallest to largest and the minimum payment amounts. Now, here's the strategy. I want you to pay the minimum on all of your accounts. Whatever the monthly minimums are, pay the monthly minimums. But I want you to pay more than the minimum on your smallest debt. So whatever that additional funds that we had left over, where you negotiated fees, you reduced some items on your monthly expenses, when you looked at those 3 months of credit cards and bank statements, I asked you to give me a number. What was your overage? What was your surplus from your reductions? Use that and put that additional money on your smallest debt. So you're looking at your smallest debt, you're paying the monthly minimum on that debt, plus the surplus that you have on that smallest debt. And I want you to do that until you eliminate that debt. And once you eliminate that debt, here's the goal. Once you eliminate that smallest debt, you will then take the minimum payment that you were putting on that smallest debt, and you will put that on the next debt. So we're going smallest to largest. So that first debt is now eliminated. So the payment from that first debt is now going on to debt number 2. So you're already paying debt number 2 its minimum payment. Now the minimum payment from debt number 1 is freed up. So you're going to put that on debt number 2, as well as the surplus that you are putting on debt number 1 will also go on debt number 2. So now you really have 3 payments going on debt number 2. Debt number 2's monthly minimum, the monthly minimum from debt number 1, and the surplus. Once debt number 2 is paid off, what are we going to do? We're going to repeat the strategy now for debt number 3 until we have worked our way out of debt. And all of this is going to be on auto pay, so you don't have to think about it. Once the bank alerts you that that creditor has been satisfied, you will then put the second creditor on auto pay and increase the amounts. Set it and forget it. And this is the strategy that we will employ, and you will see that while these debts were 10 years out, 5 years out, you're going to pay them in half the time, and you're going to cut the interest in half. Here's a case in point. I have a 30-year mortgage on my house, but I pay the mortgage payment bi-weekly. By doing that, the lender told me, Mr. Thomas, you have just reduced your mortgage from a 30-year mortgage to a 24-year mortgage. But I want it to be even more advanced than that, so I give an additional mortgage payment on top of that. Now the mortgage is down to like 18 years. So now the goal is, I'm thinking, how can I free up additional capital so that I can give 2 additional payments and get it down to a 15 or 14-year mortgage? Do you see how you do that? So the more they give you the minimum amount, because when you pay the minimum, they get to charge you interest on the unpaid balance, and that's how they make their money if the interest is 16 to 29%. So don't pay the minimum. Zero the card out. You want to pay the minimum balance on the first one, but you want to add that surplus. So you're adding more to it. And once it's eliminated, you're going to do the same strategy for debt number 2 and debt number 3. So yes, all of the other debts will receive the minimum payment until that first debt is paid off. But once that first debt is paid off, we're going to dump more money on number 2, pay that off, dump all the rest of the money on number 3, and we're going to keep building that snowball. It's going to gain momentum going down that hill, and the more it rolls, the bigger it's going to get. Any questions, please? Okay, so let's move to the next slide, please. So I want you, now that you have your 4 buckets set up, and now you have a strategy for identifying your debts from smallest to largest, and you have a snowball strategy in place to make sure that you are eliminating debts one at a time and celebrate every victory. Now I want you to understand what to do if a debt collector calls your home. We're going to deal with debt collecting strategies, and next week we're going to deal with credit repair. Everything is sequential. These steps must be followed sequentially. We're building an infrastructure. So, how many people on the call actually have debt collectors contacting them? Does anybody have debt collectors currently contacting them? Okay, let me just say this. You do not owe a debt collector a dime. You do not owe a debt collector a dime. A debt collector went to your original creditor and they purchased your debt for pennies on the dollar. That's what happened. Your original creditor more than likely took what is called a charge off. If they took a charge off, that means they received a tax credit for that debt. So they received a remedy. They were satisfied. The debt collector then comes and purchases that debt for pennies on the dollar because the debt collector figures, if I buy the debt for pennies on the dollar, even if the consumer negotiates to pay less, they're going to still pay me more than what I paid for their debt. So I still make a profit. But here is the caveat. You don't owe a debt collector anything because you never had a contract with a debt collector. You never agreed to pay that debt collector anything. So why are you contacting me when I have no contract with you? So here's what I want you to do. We have our 4 buckets in place. We've identified our debt. We have a debt elimination strategy in place to start eliminating that debt. And now we're going to make sure that in the meantime, if any debt collectors are calling us, we're not going to allow those debt collectors to put us in deeper debt or to create entries on our credit report that will lower our credit score so that now we're subject to higher interest rates and APRs that's going to put us in deeper debt. So we're going to cease that immediately. So here's what you do. When a debt collector calls your home, you will inform the debt collector, I do not do business over the telephone, or I do not discuss business affairs over the telephone.
Mr. Thomas.
Yes, ma'am.
What about hospital bills? There's a question in chat. What about hospital bills?
It's the same thing with hospital bills. And here's the thing I want to say about hospital bills. When you go to the hospital, if you know when you go to the hospital that your expenses just about takes all of your take-home pay, you can ask the hospital for something called charity care. Write this down. You can ask them for charity care. Charity care, the hospital won't tell you this, but they have a division that provides charity care to those who have difficulty paying for medical bills. So if you can demonstrate that, look, after my monthly expenses, I don't have enough left over to cover the expense of my care, you can ask for charity care. They'll send you an application. And once you complete that application, they will notify you about what you're entitled to receive under charity care. So when you sign, ask them about charity care. So that's the first thing, is to be proactive when it comes to medical and hospitalizations. Ask for charity care. So also when you have hospital bills, it's the same thing. If the hospital contacts you, any creditor that contacts you, you want to satisfy your creditors because you agreed to pay it, pay it. But if the hospital then sells your debt to a third party debt collector, You have no contract with that debt collector. You're going to ask them to validate the debt. So ask them, and remember, this is so important. You have 30 days to respond. That's all you have. If you don't respond within 30 days, you are acquiescing to the debt. You're basically saying the debt is mine. You have 30 days. When they contact you, this is the debt collector. I do not discuss business affairs over the phone. Send me your correspondence in writing via postal service. They'll send you a letter. That's when you respond with a debt validation letter. All of those that are registered for the class, I'm going to email each participant a debt validation letter that you will send to the debt collector, and you will send it certified mail. Then they will more than likely turn around. They will send you a statement from the original creditor. You're not asking for a statement from the original creditor. You're asking them where is their contract, since they're the ones requesting compensation. So you will follow that up with a second letter saying this is not in regard to the original creditor. This is in regard to you as a third-party debt collector seeking compensation from me as a consumer. Where is your contract? Validate your right to a claim of debt. So I will send you those two letters. They will not be able to produce it. And so guess what? They then have to cease. And you will then contact the 3 credit reporting bureaus and let them know that you have sent them a debt validation letter, and they will not be able to report it because they cannot validate the debt. I'm going to go further into this when we get to the credit repair portion. I'm going to show you how to freeze your accounts so that debts cannot be validated and cannot be challenged, but we'll get to that when we get to credit repair. But for right now, what I'm doing now is I'm trying to create an opportunity for you to stop any further debt collection until we get to credit repair. I don't want any other debts being placed on your credit report from a debt collection agency. So when they call you over the next 6 weeks while we're finishing these classes, this is the strategy that you will put in place. You will have them send it to you in writing. You will then send them a debt validation letter within 30 days, certified mail, and you will ask them to validate. If they respond with a statement of accounts from the original creditor, you will send debt validation letter number 2, and that will cease all actions. Any questions, please? Okay, next slide, please. So here are the financial freedom is based on 6 key steps. And this is what I found when I did the research. So there are just so many financial experts out there, and this is what was shared among all of them. Number 1, you must generate income. That's the first thing they talk about, is generating income. Each of you are doing that because you have a place of employment, or you're either self-employed, so you're generating income. Step number 2, you must discipline yourself to start tracking your spending. And the best time to do that is on Sunday, because it's the first day of the week. Take at least an hour every Sunday and track your weekly expenses. Step number 3, create a surplus. And you did that. I asked you to look at your 3 months of your credit card statements, your 3 months of your bank statements, and see where you can reduce costs. See where you can negotiate fees. Can you get a lower car insurance, homeowners insurance? Do you need that Netflix account if you have Hulu and Prime? So you started looking, you started cutting. So you started creating a surplus for yourself. Or you went out and you secured a side hustle. We're going to talk about starting a home-based business. I'm going to talk to you about starting a home-based business because all of the tax deductions, and when you receive a refund from the government, how you're going to use that refund, because your home-based business has created so many deductions for you that now you're owed a refund from the Internal Revenue Service. We're going to talk about that. So I'm going to talk about all of the tax planning, not tax preparing, where you wait to the end of the year, December, and then at the end of January, you get your W-2. You meet with an accountant in February. They prepare your taxes to see what you can claim after 12 months. That's being reactive, not proactive. We're going to start January 2023, knowing what we're eligible to deduct. and we're going to deduct it all 12 months. So we're going to do tax planning, not tax preparing. And after taking advantage all 12 months, you're going to then give your preparer your documentation, and they're going to say to you very kindly, I believe that you're owed a nice refund. And we're going to put that money toward what? Our emergency savings plan and our debt elimination plan. Okay, so we're creating a surplus. Step number 4, saving for emergencies. I shared with you, before you start funding your goal savings plan, take that 20% that we've allocated for savings and build your emergency savings fund until you have a minimum $1,200. But we're working toward the goal of 3 months of living expenses. So once you have $1,200, then you'll start taking 10%, putting it in your goal savings account, and then you'll take the remaining 10% and continue funding your emergency savings plan. Step number 5, eliminating debt. That's what we talked about today, identifying our smallest debt to our largest. And we talked about the snowball method that we're going to use to eliminate debts one at a time. And the last step that they talk about that creates financial freedom is investing for wealth. We are also, after we talk about your credit score, increasing your credit score so that you can get the home, the car, whatever you want to do, we want to make sure that you're in good credit standing. And I don't say this to brag or boast, but I can't come on here and talk to you about credit scores and my credit score isn't good. I posted my credit score on social media because I wanted to share with people that, yes, I talk about it because this is where I'm at. And then I also posted how that after 30 days, I put that on Facebook as well. They notified me my score had went up even an additional 13 points. So the goal is by the end of or before Thanksgiving to be at a perfect 850. So that's what I want to do, is help you get there as well if you're not there or close to being there. So that elimination plan, the last one is investing for wealth. We're going to talk about investment strategies. And I'm going to share with you what the top investors in the country are doing, what their asset portfolio looks like. And there was a case study done. They asked all the top hedge fund owners, all of the top investors and day traders, if you had to create an asset portfolio, an asset allocation to leave to your children so that they would always be taken care of if you weren't here, how would you have them allocate their money? And so that case study gave all of the ways they say they would allocate their funds. And from that case study, they created one logical financial model. We're going to go over that so that we can put our money in similar allocations to ensure that upon our demise, we have something in place that's going to build wealth for our children and our children's children. So we're going to talk about investment strategies as well, but everything again is sequential. Any questions about that, please? Because I see here in the chat we have five. Okay, I guess people are just giving comments. Okay, so
Mr. Thomas.
Yes, ma'am.
So there was a statement or a question about multiple credit cards, and what are your thoughts on debt consolidation?
I think debt consolidation is good but you have to do the math, weigh out the fees, and then look at the percentage or the interest rate when you use that loan to consolidate all of your debts. So make sure you weigh that. You want to look at the fees that's going to be charged, and you want to look at the interest rate, and then you want to do a comparative analysis. Is this the best strategy for me to use, or to be better for me to take my surplus and use that snowball method in order to eliminate debt? So I always believe in looking at the numbers. The numbers tell the story. So it's hard for me just to give you an answer without actually sitting down, doing a comparative analysis based on your circumstance or your situation. But make sure you look at the interest rate, make sure you look at the fees, and see what is that going to cost me versus what I'm doing now, or versus if I paid off one debt at a time and freed that additional capital up and kept eliminating debts one at a time. Which one would be more cost effective, and what is the payoff date for both of those? So you want to weigh those things.
And can you accelerate that payment, correct? So like, for example, you were talking about, adding a little bit more to cut down on interest rates. So if I'm consolidating and my monthly payment is $500, but I was used to kicking out $1,000, then try to pay at least $650 or $750 to cut that interest rate down and that time down.
That's exactly correct. So, and that goes back to the snowball method. And so that's why I want you to employ that method, because by doing that, not only are you going to eliminate that debt, but you're going to have more money to put on those additional debts, and you're going to cut the time in half. And when you cut the time in half, you cut the interest in half. Now, when it comes to multiple credit cards, and we're going to talk about this when we get to credit repair. When you talk about improving your credit score is improved because they look at the lines of credit and the type of credit that you have open, installment loans, revolving loans, etc. But we'll talk about that. So having multiple credit cards is a good thing, but you have to look at utilization. So I don't want to jump into that, but we'll get into that. But having multiple credit cards can be a good thing. I just want you to abstain from department store cards, grocery store cards, all of these store cards. Try to use some top tier cards: American Express, Chase, Discover, etc. But we'll get into the type of credit cards to use as well. Any other questions?
No, continue, please.
Okay, next slide, please. Okay, so what do the rich know about money that the middle class and the lower income class don't? What do the rich know? Number one, they know this: you won't get rich off your salary alone. So that's why we're going to talk about a home-based business, because 55% of all the taxes that the Internal Revenue Service collects comes from W-2 wage earner employees. 55% of all the taxes collected by the IRS comes from people that work a 9 to 5. 10% comes from those who own a business. The other is gift tax, excise tax, etc. Those are the other miscellaneous taxes. But business owners only pay 10% of the taxes collected by the IRS. So if they're only paying 10% and 9 to 5 workers are paying 55%, that says to you, even if I keep my place of employ, I need to have a home-based business. So they know you won't get rich off your salary alone. Number two, they know you pay yourself first. What do you mean, pay myself? We're going to talk about that. Investing. When you invest, guess what? You're paying into your future. When you put money into a savings account, guess what? You're paying yourself. You're paying into your future. So always make sure that's automated. Pay yourself first. They also know that inflation steals your money, so invest. How does inflation steal my money? Right now, the bank is giving you what? 0.001%, a piece of a penny. That's what they give you in interest. But the inflation rate is 9.1%. So every day your money sits in the bank, you're losing money. Inflation can't be 9.1 and you're getting interest at a piece of a penny. You're losing money. And then if you have one overdraft fee, the little bit of interest that you were getting over the year from that piece of a penny, that's wiped out. Thus, online banks, no fees. They also know you buy assets, not liabilities. Some of us want to floss. We want to buy that Mercedes, that BMW, not knowing that's not an asset, that's a liability. It depreciates as soon as you drive it off the lot. You lost money. And you're looking at the monthly payment, but stop looking at the monthly payment. Look at the sticker price of the car, take your monthly payment, times about 60 months, and see what you're really paying for that car. So the goal is to buy assets, buy things that appreciate in value, not that depreciate. So if you're going to assume debt, you assume debt to buy assets that will produce a passive income and pay you a residual income every month. And that will allow you to exit out of the debt that you incurred within the first year. Don't spend more than you make. That's a good one, family. Don't spend more money than you make. That's why I said credit card is not free money. If you don't have the money in the bank to pay it off and zero it out that same day, Don't swipe. I don't want you to use your credit card to pay for things that you have the money in the bank to cover that same day. I go out to dinner with my wife. When I go home, I take the money from my debit account and I pay that credit card off for dinner that same night. It's done, even wash. But here's the difference: if I were to use my debit card, I wouldn't get anything. But $100 dinner times 3 times the points, I just 300 points into my account that can be used for hotel stays, flights, whatever I want to use it for. So the debit card wouldn't have gave me anything. The credit card gave me rewards. And I just took the money from the account and put it on the credit card and zeroed it out. Last but not least, they understand that compound interest works wonders. Compounded interest. When you look at the stock market, people complain about the stock market. The stock market is down, but they did a study from the inception of the stock market. Every 20 years, regardless of the economic climate, whether it was a depression, a recession, it didn't matter. Every 20 years, the stock market yielded, I believe, it was anywhere from like 8% to maybe like 9 point some odd percent. That's a lot of compounded interest. So the goal is to be in it for the long term. This is a long-term investment strategy. We're looking at 20 years. This is a 20-year strategy. We're not looking to build wealth overnight. We're looking to put a system in place that will allow us over time to create financial freedom. So when you create a structure that's on autopilot and it's investing on your behalf every month, you are building wealth and you're taking advantage of the wonder of compound interest. That's what we want to do, family. Any questions?
There was a question. What are some of the things that are good to buy?
Okay, family. So since that question was asked, I'm going to share with you what I'm currently doing. I'm currently buying gold and silver. I joined a membership club, and this is an exclusive membership where I'm now able to buy what is called MS70. MS70 means mint state. Mint state means perfect condition coins that have never been touched with human hands. They come directly from the mint. They're encapsulated and they're barcoded and they're registered to me as the collector. And because they're in perfect MS condition or perfect state, they accumulate or they appreciate. One silver coin purchased at $139 is now worth $1,700, I think, and $77 in less than a year. That's gold and silver. Why? Because gold and silver will never depreciate. Gold and silver is God's money. It's precious metals. He's not making any more of it. You can continue printing more paper, but you can't make more gold and silver. So people are acquiring it and they're collecting it, and that's an asset. Another asset could be real estate. You buy a property and now you own the property. Some people buy a property and then they flip it, but you just gave away the goose that lays the golden egg. So now a good friend of mine, Jace, shared that with me. He said, Osceola, why would you buy a property, fix it up, flip it, and then sell it? Yeah, you receive some profit from it, but that property could have kept producing a passive income for you. So now you rent that property out. People are going to pay you every month a passive income, and you still own the real estate. So real estate can be another asset. Art can be another asset. There are several things that you can purchase that can be assets. But what you want to ask yourself is this: will it produce me a passive income? Will it produce me a residual income? If the answer is no, then it's not an asset, it's a liability. And I hate to say this, family, but Robert Kiyosaki, who's one of the top financiers of our time, he actually said in Gardone, I think it's Gary Gardone that wrote the book 10X, also said that a house, if you purchase a house and you live in that house, that's not an asset. That's also a liability because it's not putting money in your pocket. It's taking money out your pocket. But if you purchase it to rent it, then it becomes an asset. Wow. I learned that late. Okay, so I hope that answers your question. Next slide, please. So here's the homework. So there was a question about medical debt. I share with you what I want you to do with medical debt when it comes to debt collectors in the meantime until we get to credit repair. We get the credit repair, we will deal specifically with that. But between now and that lesson, if any debt collectors contact you, I want you to employ the strategy that I shared with you until we get to our credit repair section. We also talked about multiple credit cards. I'm going to share with you in a lesson what credit cards I want you to select and why. You'll make a decision which ones you want to apply for. But I'm going to share with you the best credit cards to use. I'm going to share with you the credit cards you can apply for if you have bad credit, good credit, excellent credit. So everybody will be able to apply for a card and how you're going to use that to improve your credit situation. So those are forthcoming lessons. So homework assignment. Here's what I want you to do. Next week, we're going to cover increasing your credit score. So I want everybody, I'm sorry, please forgive me. I want everybody to apply or to get a copy of their credit score from all three credit bureaus, Experian, Equifax, and TransUnion. So I want you to get copies of your credit scores from all three credit reporting bureaus, and I want you to get your credit report from all three credit reporting bureaus, Equifax, TransUnion, and Experian. Next slide for me, please.
Mr. Thomas.
Yes, ma'am.
So can you clarify something? Because I think there was a little confusion. It was dropped in the chat, so it's better to rent than to buy, but I don't think that's what you were trying to say.
Okay, so
can you clarify that?
Yes. So here's a strategy. You know, when you read about these gentlemen like Gardone, and you read about Robert Kiyosaki in Rich Dad Poor Dad said this: you should live your life like a real life game of Monopoly. The goal is to access as much property and own it as possible. But when you own it, guess what you do? You own it so it produces a passive income for you. And when it produces a passive income for you, what do you do with the passive income? You let the passive income then buy the property that you live in. But the first goal is not for you to buy a house to live in. The first goal is for you to buy a house to rent so that it produces a passive income and let that passive income pay your mortgage. Now you created a separate asset over here that's going to pay the mortgage for the house you live in, and you still own the real estate, which is a part of your asset portfolio. But we go out and the first thing we do is we assume debt to buy a house, and now we have to use our monthly income to satisfy that debt, myself included. So I'll be the first person to testify that was my strategy. I did that. But the more I read and the more I become acclimated to financial strategies and investments by listening to the billionaires, I'm learning that the way they do it is they don't use their money to buy their first home. They use their money to buy a rental property and then buy multiple rental properties until those rental properties are able to pay for themselves as well as produce a passive income that can then pay their mortgage, and they don't go into debt for it. Their assets pay for it. All the money they're generating from their efforts, guess what? Goes into their investments and living their best life. That's where I want us to get to. So we have to start thinking different. It's a new financial paradigm. But that's what I want everybody to start thinking about. How can I build assets rather than putting all my money toward liabilities? We have a consumer mindset. We want to buy pocketbooks, purses, and Mercedes. More African American. I read something that said African Americans buy more Mercedes than any other race, percentage-wise. A larger percentage of African Americans buy Mercedes than any other race. Why? And when you look at the wealth gap between African Americans and whites, it's so large that they say it will never close. But that's another conversation. Okay, so when you get the copies of your credit report, here's what I want you to do. I want you to highlight any errors on your credit report, any aliases. So any misspelled names that you have on your credit report, highlight those. I also want you to highlight old addresses and telephone numbers because we're going to ask for all of those to be removed from your credit report. So highlight any errors, any aliases, any old addresses, any telephone numbers. That's the homework. Next slide for me, please. Okay, and that's it. Great. So family, I want to make sure, thank you very much, sir. I want to make sure that I'm giving honor to where honor is due because it truly is a blessing. I want to thank, and I pray that I'm saying this right. I want to thank KJ Media, our sponsor, for all that they're doing to help us and to provide this platform. So I want to give thanks. Also, family, remember, you now have your 4 buckets in place. You now have a debt elimination strategy in place. And now we're looking at improving your credit. And then we're going to look at credit card optimization so you can improve your lifestyle. We're going to talk about home-based businesses and tax deductions so that we're doing tax planning. Then we're going to talk about investing, the right insurances for you to have in place so that you can make sure upon your demise, your final expenses are taken care of and you have something to leave to your children. And then we're going to talk about estate planning. So we have several lessons coming forth, but at the end of these lessons, I want to make sure that you have a financial system in place where you will never have to worry about not being financially whole if you employ the strategies. So if you have been doing everything that I've been asking and doing the homework, because this is not Osceola strategies, these are strategies from the top financial people in the industry. So as I research it, I'm putting together my PowerPoint, and everything that they suggest is exactly what we're doing. And I'm giving you what I'm actually living. So it's not just theory, it's experiential. Any other questions before we close? Do we have any questions in the chat? Well, family, it's been a pleasure. Peace and blessings upon you and yours. Have a good evening, and Lord willing, I'll see you next week with your credit reports.